If clients are thinking about their broader asset allocation, take us for your broad views on asset classes and sectors that they should be mindful of.
Sure. So let me, maybe in somewhat rapid fire mode, I'll go through, general thoughts. Let me start first within the fixed income opportunity set in credit. You're gonna have to be careful with credit. More technological innovation could lead to better productivity, which could lead to better economic growth. But a lot of what we describe is quite disruptive. The green or the brown to the green energy transition is probably the best example. The brown companies carry a lot of the debt. The green firms tend not to. So within our fixed income portfolio, we need to be sufficiently defensive, sufficiently selective in the credit arena, because this era of transformation will lead to winners and losers. Secondly, let's look at structured products. We really like structured products in this environment. A lot of the post-global financial crisis regulations have continued to make it hard to take excessive risks within that opportunity set. Mortgages, asset backs, other areas of that marketplace. In a world of considerable uncertainty, it's great to have hard assets and pretty good documentation. So whether it's the public or the private side of the opportunity set, we really, really like that asset class. Emerging markets on the fixed income side. We find it intriguing, consistent with the idea of expanding your opportunity set to generate additional returns. Longer term valuations across the various sub-segments of the emerging market opportunity set look attractive from a top-down perspective. The challenge is that when you start looking from a bottoms-up perspective to put together a portfolio, you notice a lot of uncertainty. Political uncertainty, uncertainty around this ongoing tension with China and implications for emerging markets from that perspective. So when we look from a bottoms-up perspective, we think you have to be, again, patient and selective in that area of the opportunity set. But we do think it's a good diversifier where you can pick up some incremental return, again, within the public and the private opportunity set. Real briefly on equities, we think equity returns are going to be lower than we've gotten used to. I don't think I'm extending myself too much in terms of that general forecast, at least over the next 5 years. You do see disruptive companies or disruptors in terms of the equity opportunity set. Then finally, just touching on the private opportunity set. I mentioned earlier, we think it's important to shift one's mindset and think about opportunities in those areas of the market. All of this policy stimulus we've seen directed at sectors during this COVID shock have found their way into the easiest to own segments of the marketplace. Generic credit, rate markets, mortgage-backed securities with agency guarantees. The money hasn't flown us directly into these private opportunities. They're crowded in some areas, of course, but we think by expanding into these areas over the next 5 years, you'll be able to seize liquidity premium, complexity premium, obtain the type of control that you typically can't get within the public arena, and generate attractive returns in the context of a broad asset allocation. So again, one of our higher conviction themes for the next 5 years.